I'm going to talk briefly about main economic developments in the last month or so and in the impact on the property markets of South Africa. Now, it seems like economic life is pretty much about energy these days. It's either about petrol prices or about electricity prices or the reliability of electricity in South Africa. And this has key potential impacts in various ways for various property markets here. Now, firstly, I think let's talk about the petrol price hikes. There's been a series of them. This is not the first one, another 2 Rand a litre up in early July, but this is just the latest in a long series of hikes, and petrol prices have become pretty exorbitant as of late. Now, the first impact, the key impact, is the indirect one via interest rates. Petrol prices are a key driver of CPI inflation. CPI inflation just over a year ago was down at 2%. It's now, the most recent number, 6.5% year on year. It's above the SARB's upper target limit of 6%, 3 to 6% being its target range. We've already seen interest rates going up since late last year, and I think another percentage point worth of interest rate hikes before the end of this year is possibly a reality. So there's an interest rate impact, and we know that property markets are credit driven, or credit dependent, should I say, and therefore interest rate sensitive. And so I don't think it's any surprise that we've probably already seen demand in the residential market slowing. That's a highly credit dependent one. And more recently, our FNB property broker survey suggests that in office and retail, sales activity in the second quarter slowed from the first quarter already. So interest rates possibly starting to have an effect on buyer activity in certain commercial markets as well. Rising interest rates short-term interest rates can exert upward pressure on longer term, the government long bond yields, for instance, the long bond market, and thus can have upward pressure on property capitalization rates and downward pressure on real property values. Therefore, that's what I would anticipate from in terms of impact points, although it's difficult to quantify, and there are other factors also influencing cap rates and property values at the same time. So that's the big indirect impact via the interest rate impact on property. Then there's a slower global growth impact. South Africa is a very open economy. The global economy is being dampened by high oil prices. It's being dampened by rising interest rates, partly as a result of the inflationary impacts of oil prices, but not only. And if the world economy slows as a result of this, that means dampening in demand for South Africa's exports, which means dampening GDP growth. And if GDP growth is slower, that normally means slower growth in demand for commercial and industrial space. So there's a GDP impact via the world economy too. Then there's some more direct impacts that we should probably look at, and that's consumer reprioritization of expenditure. Now, as inflation rises, driven by petrol prices, consumers have to reprioritize expenditures. And interest rates take a chunk too of debt repayment, an increased chunk of debt repayment from their disposable income. So consumers have to reprioritize to afford their debt repayments, to afford higher petrol price costs, because they can't just stop all their transport. A lot of transport is unavoidable. And what do they reprioritize away from? It's probably non-essential items. It's eating out, entertainment, luxury goods, and postponable purchases. It could be clothing and footwear, which is essential, but isn't needed right now. We can postpone a lot of it. So that's what consumers would probably reprioritize away from. The food and grocery shopping, that essential day-to-day spending, probably remains relatively unscathed. I think this plays into the hands of smaller convenience and neighborhood shopping centers that focus much more on those essential items, and it militates against, or works against the bigger shopping centers effectively, the regionals, the super regionals, which are often more focused on entertainment and luxury shopping and low frequency purchases, and less so on the food and grocery shopping. So I think that the smaller centers in the neighborhoods, the convenience, the community centers have a relative advantage through this tough inflationary time. The regionals and the super regionals are at a relative disadvantage. Then there's office space. Now, office space has been struggling even before COVID-19, but then the additional impact of COVID-19 lockdowns, the forced lockdown work from home experiment, which was a rousing success. That's led to certain companies reprioritize or replanning their office space needs and often downscaling on office needs because there's greater levels of work from home these days than what there were prior to COVID. So that's already a negative impact on the office property market. Now add to that much higher commuting costs due to the cost of petrol. And you would think that a lot of employees, where possible, would push for working from home even more than has been the case to date. So that can be an additional source of downward pressure on the daily office occupancy rates. And it can conceivably lead to companies looking around and saying, well, there's a lot of desk space here every day. We can cut back even more on our office space requirements. Not do away with it, but cut back even more. So I think it's an additional source of pressure for the office property market. So that's those are the key commercial property, of the main commercial property sectors and residential. I think those are the key impact points. Then there's a smaller sector, the hotel property sector. A direct impact there from transport, I believe. Higher transport costs, higher petrol costs. I think non-essential holiday travel will be curbed by that. It's not essential and it's expensive now, be it air travel or vehicle travel. Less holiday travel probably means less demand for hotel space than would otherwise be the case, hotel rooms. So hotel incomes can remain severely under pressure. They have been under pressure even without this, struggling to recover from lockdowns. This is an additional unneeded source of pressure on the hotel property market at the moment. Then we get to Eskom and electricity. Now, earlier this year, a double-digit tariff hike again. Electricity is becoming ever more exorbitant in this country, and that's a key operating cost component for commercial properties, notably retail property centers. So electricity costs have been troublesome for years, and they get more troublesome with the latest tariff hike. But then there's the reliability aspect. Stage 6 load shedding recently, now down to stage 4 as this video gets made. It doesn't matter stage 4, stage 6, it's disruptive to the economy. Disruption to the economy, lower than would otherwise be the case GDP growth, well, that has implications for slower GDP growth. All other things equal, probably means slower demand growth for commercial and industrial property space. So that has a dampening impact too on the commercial property sector. And for residential, obviously, it can mean that less job creation in a weaker than otherwise economy means less residential demand too, because residential demand is all about affording a home loan by having a reliable income. Okay, so there's a significant potential impact of the severe load shedding, depending on how long it lasts, obviously, via the economy on the well-being of the property market. Finally, let's finish off with a little silver lining. Let's go back to the residential market and look at the residential rental market. The residential rental market took a big knock during the lockdown period. A lot of tenants lost their incomes and needed some sort of relief from landlords. They recovered quite nicely. Their percentage in good standing has bounced back quite nicely according to TPN data. That's great. And there is the rental market, which saw a very high vacancy rate just over a year ago, up above 13%, has seen its vacancy rate decline and has seen rental deflation turn back into inflation, according to TPN numbers yet again. I think that the petrol price hikes, the rise in CPI inflation, the rise in interest rates supports further recovery in the residential market, the residential rental market, because a portion of aspirant home buyers who are credit dependent will postpone their purchase while interest rates are rising and hang out in the rental market for more. So greater rental demand, weaker home buying demand. So the residential rental component, I think, can benefit in the short term from this rise in petrol prices and rise in broad inflation and rise in interest rates.